On February 20th, 2026, the Supreme Court struck down every major tariff that had been passed in 2025. 3 days later, a brand new global tariff was signed, 10% on everything, then raised to 15% the very next day. At the same time, the latest jobs report shows the economy losing 92,000 jobs in a single month when economists were expecting growth. Oil prices are climbing because of tensions around Iran and the Strait of Hormuz. The Federal Reserve is stuck between cutting rates and risking inflation, or keeping rates high and slowing the economy even further. And the federal government is already $700 billion over budget, just halfway through fiscal year 2026, with the national debt now sitting at $38.8 trillion. If you run a business doing $1 to $10 million a year, you're sitting right in the middle of all of this. Your revenue might still look solid on paper, but underneath that, costs are rising, labor conditions are shifting, and borrowing is expensive. The tax environment just changed in ways many business owners have not even heard about yet. Now in this video, I'm going to walk you through what is actually happening in the economy right now, what the 2026 tax law changes mean specifically for a business like yours, and the moves that separate the owners who come out of this ahead from the ones who just keep absorbing the damage quietly. Near the end, I'm going to walk you through the single most expensive mistake I see business owners make when the economy gets unstable. It is costing some of them six figures, and most of them do not even know that it's happening. So stay with me. Let me start by giving you the real economic picture right now. Most business owners are seeing headlines but not connecting the dots back to their own businesses. First, we need to talk about the debt and deficit situation. The United States national debt is now at $38.8 trillion according to the US Treasury. We're only weeks away from crossing $39 trillion. In fiscal year 2026 alone, the government has collected about $1.78 trillion in revenue, but has already spent around $2.48 trillion. That means the government is already about $700 billion over budget, and the fiscal year is not even finished. Every time the government spends more than it collects, it borrows the difference. That borrowed money becomes national debt. The interest payments on that debt have been rising every single year since 2020. The projections through 2036 shows those interest payments accelerating even faster. So what does that mean for you as a business owner? It means the pressure on Washington to raise taxes or change tax policy is not going away. The tax incentive available right now will not necessarily exist forever, which is exactly why planning matters more during periods like this. Now, let us talk about the job reports that most people barely notice. The most report shows the economy losing 92,000 jobs in February. Just 1 month earlier, the economy added about 130,000 jobs. That is a complete reversal in 30 days. Unemployment moved up to 4.4%. Private payrolls declined. Manufacturing, construction, and parts of the healthcare are all showing signs of weakness at the same time. And here's something most headlines do not explain clearly. The unemployment rate you hear about does not include people who stop looking for work. It does not include underemployed workers who want full-time jobs but can only find part-time work. And it does not fully capture gig workers with unstable income. So the real stress inside the labor market is usually wider than the headline number suggests. For small businesses, this matters a lot. If you rely on skilled field workers like plumbers, electricians, HVAC technicians, roofers, or installers, a shifting labor market affects both hiring and retention. When the market softens, your best people often get recruited more aggressively by competitors, while your hiring pipeline becomes less predictable. At the same time, your costs are rising. Another factor that could affect your costs very quickly is what's happening with the oil in the Strait of Hormuz. Roughly 20 to 30% of all globally traded oil passes through that single corridor in the Middle East. Right now, tensions around Iran have created serious concern about that shipping route. Insurance providers have already reduced war risk protection for tankers operation in that region. If oil moves from $70 a barrel to $110 a barrel, the chain reaction in the economy happens quickly. Gas prices rise, shipping costs rise, groceries get more expensive, airfare rises, and for a business running a fleet of trucks or vans every day, fuel becomes a direct hit to your margin almost immediately. There are also tariffs affecting global energy flows right now. Tariffs have already been applied to countries purchasing Venezuelan oil. Tariffs on Iranian oil followed in early 2026, and tariffs on Russian oil were imposed on in 2025. Those upstream pressures eventually flow down into your fuel prices your company pays every month. And fuel costs are not the only thing affecting what businesses pay right now. The the tariff landscape just changed almost overnight. On February 20th, 2026, the Supreme Court ruled that the use of emergency powers to impose certain tariffs was unconstitutional. That decision eliminated several tariffs that had been implemented in 2025. Within 3 days, a new global tariff was signed under a different law, and then 10% on imports initially, then raised to 15% the very next day. Steel and aluminum tariffs under a different authority were not affected and remained fully in place. What does it mean in real numbers for businesses? Research estimates that businesses absorb roughly 80% of the tariffs cost in 2025. Small businesses alone have been carrying about $85 billion in tariff costs annually. And when you include indirect costs like compliance, custom fees, and supply chain disruption, that number can approach $100 billion. For trades businesses, this show up immediately in material costs. Steel, aluminum, copper, and lumber all feed directly into roofing, HVAC, plumbing, and construction work. And the bigger issue is not just the cost, it's instability, because these policies can change quickly and businesses are left adjusting prices and margin in real time. And that is the bigger economic picture right now. But the real question is what you can actually control inside your own business. While all of those economic pressures are happening outside your business, the tax environment inside your business just changed significantly, and many business owners have not been told about this yet. On July 4th, 2025, a new tax law called One Big Beautiful Bill Act was signed, and 2026 is the first full year that laws was in effect. And that's not a proposal or theory, that's already part of the tax code. And for trade and home service companies, it contains several powerful financial levers. But those levers only work if someone is actively pulling them. Let me walk you through the 5 changes that matter most. First change, the 20% qualified business income deduction. If your business operates as an LLC, an S corporation, a partnership, or sole proprietorship, you may qualify for what's called the QBI deduction, and this allows you to deduct up to 20% of your eligible business income before calculating your tax bill. Before the new law, this deduction was scheduled to expire after 2025, but is now permanent. For example, if your business generates $500,000 of qualified income, that deduction alone could reduce taxable income by $100,000. And that is a major planning opportunity. If you're not sure whether your business structure and payroll setup allow you to capture the full value of that deduction, that is a conversation worth having soon. Next, let's talk about the corporate tax rate. For C corporations, the federal corporate tax rate remains at 21%. There have been discussions about raising that rate significantly, but the new law kept it where it is. And that can be beneficial for certain businesses depending on how profits are structured and distributed. But here's the key point. Your entity structure needs to match your revenue level, compensation strategy, and long-term goals. Many trades businesses grow into the wrong entity structure over time simply because no one revisits the decision. A quick entity structure review can often reveal planning opportunities that have been sitting there for years. And the third change is the one that can have a major impact for equipment-heavy businesses like many trade companies. 100% bonus depreciation is now permanent. That means qualifying equipment, vehicles, and machinery can often be fully expensed in the year they're purchased rather than depreciated over several years. For trade companies that invest heavily in trucks, trailers, tools, and specialized equipment, that rule can dramatically change how purchases affect your taxes. If your business replaces vehicles, expands the fleet, or purchases major equipment this year, the timing documentation of those purchases becomes very important. Handled correctly, the entire cost may be deductible in the same year the asset is placed into service. Now, the fourth change focuses on retirement planning for business owners. The SEP IRA contribution limit increased to $72,000 in 2026. For many owner-operators, this is one of the most powerful tools available for both tax deductions and long-term wealth building. Every dollar contributed to a properly structured SEP IRA reduces current taxable income while building retirement assets for the future. Yet, many owners contribute far less than the maximum allowed because no one calculated the optimal contribution amount during the year. That difference often ends up going straight to the IRS instead of staying in the business owner's retirement account. The fifth change affects owners operating in higher tax states. The state and local tax deduction cap increased from $10,000 to $40,000. If your business operates in states like New York, California, New Jersey, or Illinois, this adjustment can significantly change your overall overall tax picture, but it only works correctly when your bookkeeping and tax structure are aligned with the new rules. Without planning, many businesses will not capture the full benefits. And there's one additional change worth mentioning. The new law introduced a deduction of up to $10,000 per year on car loans interest for vehicles assembled in the US States. For trades companies financing trucks and fleet vehicles, that interest deductions can add up quickly over time. But like most tax rules, the benefits only appears if the financing structure and documentation are set up correctly. So now let me show you the mistakes I see most often in trades and home service companies at this revenue level. And it's usually not what people expect. It's not overspending, not hiring the wrong people, and it's not even pricing. The biggest mistake is assuming the accountant is already handling the strategy. And here's the reality: most business owners have never been clearly told. They're compliance accountants and they're strategic advisors, and they serve different roles. A compliance accountant focuses on filing accurate tax returns and financial reports to make sure the numbers are correct and the filings are submitted on time. And that work is important, but compliance happens after the year's over. Strategic planning happens before the year is finished. By the time April arrives, most of the financial decisions that affect your tax bill have already happened. Your entity structure was already set. Retirement contributions were either made or missed. Equipment purchases were either structured correctly or they were not. Income timing decisions have already taken place. A strategic advisor works with you during the year. Planning conversations happen in the first quarter, the second quarter, and the third quarter, not after everything is finalized. In an environment like the one we're in right now, where tariffs are shifting, fuel costs are volatile, and labor market is changing, and a major tax law just took effect, that difference matters even more. For many businesses in the $2 to $5 million revenue range, the gap between the compliance and strategic planning can easily reach $40,000 to $80,000 a year in taxes, sometimes even more. Not because of aggressive loopholes or risky strategies, but simply because no one is actively managing the tax levers that already exist in the law. So what are the business owners who come out of this environment stronger actually doing right now? First, they're not waiting until April to think about taxes. They're viewing their entire structure against the new 2026 rules to make sure the business is positioned to capture the full value of the QBI deduction. They're evaluating whether their compensation strategy supports that deduction properly, and they're also maximizing their SEP IRA contributions early in the year instead of waiting until the last minute. Every month that passes without planning is a month of potential tax savings that cannot be recovered later. They're also reviewing every equipment purchase and vehicle acquisition for the year to make sure it qualifies for the full first-year expensing under bonus depreciation. They're tracking rising fuel costs and material costs carefully inside their books. So those expenses are categorized and documented correctly, and they're having real conversations with their advisor about how the SALT deduction change, vehicle financing deductions, and tariff-driven cost increases affect their business specifically. None of these steps are complicated. They simply require someone paying attention early enough in the year to make adjustments while there's still time. If listening to this made you realize that you have not had these conversations with your current accountant, or that your entire entity structure has not been reviewed in years, the next step is straightforward. Schedule a HavenStone strategy session. During that call, we look at your current business structure, your tax position, and the specific opportunities available under your 2026 tax rule. The link to book a meeting is below. And with everything changing in the economy right now, the earlier in the year that planning starts, the more flexibility you have to actually act on it. If you found this helpful, subscribe for more conversations like this. And if you know another business owner who is watching these economic headlines and wondering what it all means for their company, share this with them. I'll see you in the next video.